Canada is known for a lot of things around the world. Saying sorry too much, being genuinely polite, hockey, excellent maple syrup. But more recently, some less flattering things have been added to that list. Unaffordable housing and household debt levels that are genuinely alarming. In Vancouver right now, a modest three-bedroom bungalow built in 1949 can list for over $5 million. In Toronto, the average home price sits above $1 million, and across the country, the gap between what Canadians earn and what homes cost has never been wider. Home prices have doubled in the last decade. Wages have increased about 24% over the same period. The math doesn't work, and more Canadians are feeling it every single month. So today I want to answer one question honestly. How bad is it really? And what does it actually mean for you? I'm Sebastian. This is Canadian Finance, education, not advice. Let's get into it. To understand where we are, you need to understand where we've been. And the most important comparison point is 2008. During the 2008 financial crisis, the U.S. housing market collapsed. Rising interest rates combined with decades of reckless lending caused mortgage delinquencies to surge and home prices to fall more than 20%. It contributed to one of the worst economic downturns in modern history. Just across the border in Canada, things were dramatically different. Home prices fell just 9.2% from peak to trough, and within 2 years, Canadian properties had recovered all of their lost ground. Most analysts credited this to Canada's mortgage lending practices, where America's loosely regulated finance sector had allowed risky loans, speculation, and leverage stacked on leverage. Canada's Big Six banks were conservative, well-capitalized, and closely watched by regulators. That resilience, however, has been a double-edged sword, because while America's correction did make housing more affordable for a period, Canadian properties never experienced a similar reset. Prices just kept climbing. Even after accounting for the pullback from the 2022 pandemic peak, Canadian home prices have doubled in the last decade, while wages, as I mentioned, are up only about 24%. Today, it's estimated that a household needs a minimum income of $180,000 to afford the average Canadian home price of $750,000. The median family income sits at roughly $121,000. That's 33% below what's needed. For the average family, the average home is out of reach. And that's the national average. In Toronto and Vancouver, two cities that together hold roughly a quarter of Canada's population, average prices have reached $1.1 million and $1.2 million respectively. That's roughly 9 times the average family income in those cities. For a detached home, you can double that multiple. For a generation of young Canadians, the traditional path to homeownership isn't delayed. In many markets, it's been removed entirely. Now here's the question that puzzles people outside Canada. Look at a map of this country and the one thing you notice immediately is that we are not short on space. Canada is the second largest country in the world and ranks only 38th in population. So how can a country with this much land struggle to house its people? The answer is concentration. About 3/4 of Canadians live in large urban centers, and the density in those areas is only increasing. Between 2016 and 2021, Canada had double the population growth of every other G7 country at 5.2%. Last year alone, Canada's population grew 2.7%, over 1 million new people, the largest single-year increase in our history. Most of that growth landed in Toronto, Vancouver, Calgary, and Montreal, cities that were already strained. But population growth isn't the whole story. Plenty of American cities have higher population densities than Toronto without anywhere near the same affordability crisis. The bigger issue is supply. Canada has the lowest housing supply per capita of any G7 nation, 424 units per 1,000 people. The Federal Housing Agency estimates Canada needs 5.8 million new homes to restore affordability by 2030. We're currently on pace to build less than half that, and building more homes sounds simple until you try to actually do it in Canada. Right now, there are over 80,000 unfilled construction job vacancies across the country. It's been estimated that going from acquiring undeveloped land to completing a building in Toronto takes 8 to 10 years, partly because of bureaucratic delays and zoning restrictions that have made densification incredibly difficult. In Toronto, the most populated city in Canada, the majority of residential land is still zoned for single-family homes only. Mid and high-rise development is restricted to a handful of corridors. In the most expensive housing market in the country, the rules actively prevent the type of construction that would make a dent in the shortage. The federal and provincial governments have introduced some measures: a tax-sheltered savings account for first-time buyers, a foreign buyer ban, vacancy taxes in some markets. The zoning issue has received more attention recently, but meaningful progress on the supply side has been slow. Ontario's attempt to open the protected greenbelt around Toronto for development ended in a corruption scandal and was reversed. Building more homes has been easier said than done for a long time in this country. And while all of this was happening, rock-bottom interest rates for 15 years turned real estate into the most attractive asset in the country for investors. When your savings account earns nothing and bonds pay almost nothing, and a rental property can be bought with cheap debt, cash flowed monthly, and has a 30-year track record of appreciation, the money flows in. In 2020, it was estimated that 1 in 5 homes in BC, Ontario, New Brunswick, and Nova Scotia were investor-owned. In some Vancouver subdivisions, that number was as high as 42%. As prices outpaced incomes, Canadians did what they felt they had to do. They borrowed the difference. Canadian households now carry $185 of debt for every $100 of disposable income. 75% of that debt is tied to mortgages. This is the highest level of household debt among all G7 nations. Canada's household debt to GDP ratio today is higher than America's was in the lead-up to the 2008 financial crisis. Let that sit for a moment, and now interest rates are no longer near zero. The Bank of Canada raised its policy rate from 0.25% all the way to 5% to fight inflation, and the impact on Canadian mortgage payments has been severe. Mortgage payments as a percentage of income reached 59.3% in 2023, up from 43% just 2 years earlier. For context, financial advisors recommend housing costs stay below 32% of gross income. The average Canadian mortgage payment is now nearly double that recommended ceiling. Here's what that looks like in real dollars. If you took out a $500,000 25-year mortgage in January 2022 at a variable rate of 1%, your monthly payment was roughly $1,890. At a 6% rate, that same mortgage costs $3,222 a month. That's $1,332 more every single month, coming from a budget that was already stretched. And this isn't hypothetical. Canadian news has been full of these stories. People who believed they were building wealth for their future are now facing the very real possibility of financial ruin because of a rate increase they were told not to plan for. Now you might think, okay, but how many people took variable rate mortgages? Surely most people locked in fixed rates. Actually, during the pandemic, most new mortgages were variable. Banks offered variable rates at a significant discount to fixed rates, and after a decade of near-zero interest rates, a lot of Canadians assumed low rates were the permanent normal. About 1/3 of all Canadian mortgages are currently variable rate, but here's the part that affects everyone, including fixed-rate holders. Canadian fixed-rate mortgages aren't truly fixed. Rates are locked in for a term, typically 5 years or less. After that, the mortgage resets at whatever the current market rate is. Over the next 5 years, essentially every Canadian with a mortgage will experience some financial impact from higher rates. The only question is when and how much. And now we get to the part that most Canadians haven't heard about, because it's complicated and it sounds almost too bad to be real. In most provinces, with the exception of Saskatchewan and Alberta, Canadian mortgages are recourse loans. That means if you can't pay your mortgage and the sale of your house doesn't cover what you owe, the lender can come after your other personal assets to recover the difference. You can lose the house and still owe the bank money. That's already concerning. But there's something else. 3/4 of variable rate mortgages in Canada are fixed payment mortgages. That means the borrower pays the same dollar amount every month regardless of what interest rates do. When rates go up, more of your payment goes to interest and less goes to paying down the actual loan. When rates go up far enough, you hit what's called the trigger rate, the point where your entire monthly payment is just interest. You're not paying down the mortgage at all. And when rates go past that trigger point, some borrowers start experiencing what's called negative amortization. The interest that isn't covered by the payment gets added back onto the principal. Your mortgage balance is actually growing even while you're making payments. Every month you pay, you owe more than you did the month before. This isn't a fringe scenario. DJ&D estimated that over 3/4 of variable rate fixed payment mortgages had already surpassed their trigger rate. And 3 of Canada's big 6 banks disclosed that 20% of their mortgage portfolios consisted of negative amortization loans. 1 in 5 mortgages at some of Canada's biggest banks. So why haven't we seen a wave of defaults? Because so far Canadians have been absorbing the pain quietly. During the pandemic, Canadian households built up significant cash savings. Checking and savings deposits rose 40% between 2019 and 2022. That buffer has been keeping many households afloat, but it is not infinite, and as that savings cushion erodes, the pressure will intensify. Meanwhile, new listings are down sharply from a couple of years ago. Sellers who can hold on are choosing to wait rather than take a loss. Even if buyer demand has fallen, supply has fallen with it, which has kept prices from collapsing the way you might expect given the financial stress underneath. So what happens next? And this is the part where I have to be straight with you. Nobody actually knows. Anyone who tells you with certainty that Canadian housing will crash or that it definitely won't is telling you more about their confidence than their analysis. Here's what we can say. On the pessimistic side, rates could stay high longer than expected or go higher. If that happens, the savings buffers run out, delinquencies rise, listings surge, demand collapses, and prices fall. And given that 21% of Canada's national wealth and 1.3 million jobs are tied to residential real estate, a real correction would be felt across the entire economy. On the more optimistic side, inflation has been cooling and the Bank of Canada has already begun cutting rates. If rates come down meaningfully over the next 2 years, pressure on variable rate borrowers eases, renewals become less painful, and the market stabilizes without a full crash. Canada's conservative lending practices and strong immigration-driven population growth remain genuine demand supports. What is clear is that the current situation is not sustainable. Mortgage payments at 59% of income, household debt higher than pre-crisis America, a structural shortage of housing with no credible plan to fix it quickly. These conditions cannot continue indefinitely without either a market correction or a major policy breakthrough, or both. And beneath the aggregate statistics, there are individual Canadians being crushed right now. People who bought in good faith, passed the stress test, were told by their realtor, their banker, and the broader culture that real estate always goes up in Canada, and are now seeing their financial lives threatened by a rate environment nobody in the industry warned them about seriously. That is not their failure. Nobody runs the numbers, including scenarios for rates tripling in 18 months. Most people aren't financial analysts, they're just trying to own a home. So let's talk about what this means for you specifically. Because the macro picture matters, but what matters most is your own situation. If you're considering buying your first property, focus on affordability and your genuine risk tolerance, not on timing the market or fear of missing out. Home prices do tend to appreciate over the long term, but that doesn't matter if you can't survive the short term. The CMHC recommends that housing costs not exceed 32% of your gross monthly income. In 2026, that number is widely being ignored. Don't ignore it for yourself. If you can't afford to buy right now, that's not a failure. Park your money in your TFSA, invest in XEQT or a similar low-cost ETF, and let it compound while you wait. That money is growing, it's not sitting still, and it maintains the flexibility that a mortgage does not. If you want real estate exposure without taking on a full mortgage, real estate investment trusts or REITs are worth understanding. They're publicly traded, liquid, and give you exposure to Canadian real estate without concentrating your entire financial life in one property in one postal code. If you're currently experiencing strain from your mortgage, speak to a professional, a financial advisor, a certified credit counselor, or a licensed insolvency trustee. They can help you evaluate whether to hold, sell, refinance, or extend amortization. There is no shame in asking for help when the environment changed on you in ways you couldn't have fully anticipated. And don't forget renters. This conversation often focuses entirely on buyers, but renters are being squeezed too, by landlords passing on higher costs, by reduced supply as investment properties get pulled from the rental market, by a system under stress that affects everyone whether you own or not. If this gave you a clearer picture of where Canada's housing market actually stands, hit subscribe and turn on notifications. Every week I break down the numbers that matter most for Canadians and drop a comment. Are you a homeowner, a renter, or someone trying to figure out your next move? And drop your province? Because this story plays out very differently in Toronto versus Calgary versus Halifax. I read every comment. I'm Sebastian, this is Canadian Finance, and I'll see you in the next one.